Wallet data shows that 99.6% of retail Memecoin traders are currently unprofitable. Even when these traders identify a viral narrative early, they frequently watch their capital vanish within seconds of clicking buy, because their entry price and position size left no room for error. A chart can accelerate upward for minutes, drawing in a wave of retail buyers, before it violently reverses into a total collapse. These abrupt reversals are often calculated. They function as structural traps designed to convert late-arriving retail capital into exit liquidity for early insiders. To survive this environment, we use a three-step defensive system. This framework identifies the mechanics of the trap, dictates a mathematically safer entry point, and uses position sizing to reduce the influence of panic on your decision-making. Capital preservation is the priority here. In a market where 99% of tokens eventually go to zero, the goal is to extract profit and exit before the collapse occurs. New token launches trigger an immediate emotional response. When a chart begins printing vertical green candles, the instinctive reaction is to buy immediately to avoid being left behind. This initial momentum often hides a bundle trap. In the current market, token deployers frequently control 30 to 50% of the total supply across dozens of secret wallets before the public can even participate. To draw in buyers, deployers use automated bots to generate fake trading volume. This creates a deceptive appearance of organic demand and high-speed momentum. Buying into this initial spike, even with a small amount, places your capital at the mercy of the deployer's sell button. Once retail liquidity reaches a certain threshold, the deployer liquidates the bundled supply. This results in an immediate 70 to 90% drawdown for anyone who bought the initial run-up. This chart tracks a typical launch sequence. We see a sharp vertical price spike driven by insider bots. As the insider supply hits the market, the price falls vertically. This red pillar represents the exit of the bundled wallets, wiping out the initial gains. A structural dump of this magnitude will crush a token, regardless of its community strength or the quality of the meme. The only way to survive this phase is to wait. By refusing to buy the launch spike, you force the insiders to exit their positions before you ever risk a single dollar. After the insiders have exited, we look for a specific buying opportunity in the aftermath of the crash. This is the max doom phase. The frantic selling stops, and the price action becomes flat and lifeless. To the average observer, the coin looks dead. On the chart, this appears as a horizontal baseline following the crash. The vertical volatility has disappeared, replaced by a steady price floor. This flatline area represents the optimal entry window. Entering here means you are no longer competing with the deployer's initial bundle. However, a flat chart alone isn't enough. We must verify that the token has the potential to revive by looking for external signs of life. While the chart on the left remains flat, we check the social metrics on the right. We look for active community members, consistent updates from the founder, or the meme beginning to trend on external platforms. If a community continues to grow while the price is at its lowest point, it validates the underlying narrative strength of the coin. Only after confirming this organic activity do we execute a buy order within the consolidation zone. This entry price acts as a defensive shield. Because you bought the bottom of the crash, you can withstand future volatility that would liquidate those who bought higher. The final step in the framework addresses position sizing, the mathematical method for reducing emotional bias during a trade. Many traders attempt to catch up by risking 10% or more of their total portfolio on a single speculative coin. High-risk allocations create high-stress environments. When a position is too large, even a minor 5% dip can trigger the panic that leads to selling at the bottom. This logic model shows the danger. On the left, a 10% risk allocation puts extreme tension on the trader's resolve during a standard market dip. We replace this with a disposable allocation. This is an amount small enough that its total loss would have no impact on your standard of living or your ability to continue trading. On the right side, the calculated risk allocation remains stable. The tension rope stays slack because the potential loss is emotionally insignificant. This allows you to hold through the volatility that forces other traders to exit. While they cut their losses in a panic, you remain in the trade because the size of the position doesn't threaten your portfolio. If the narrative succeeds, a small, well-timed entry can still produce a 20x or 50x return, which has a meaningful impact on your total capital. Proper sizing transforms trading from a test of willpower into a process of objective analysis. By combining these 3 steps, dodging the insider bundle, buying the max doom flatline, and sizing for detachment, you move from the 99. Now that your risk management is secure, the next requirement is learning to filter through thousands of coins to find the ones with actual viral potential. In our next session, we will break down the narrative analysis framework, the specific method for identifying high-conviction coins before the rest of the market notices them.